Hey, so in this video, what we're going to talk about is free cash flow, FCS, F as abbreviated, right? So what is free cash flow? Well, free cash flow is the number, it's an important number because that's the number that we want to use when we are doing our discounted cash flow valuations, that's the number that we want to estimate in future years and pull back to present value when we're doing our DCF calculations for a company or for any income producing asset, right? So what is free cash flow? Well, basically it's the discretionary dollars. And by discretionary, I mean available for use, the money that management has at its disposal each year, the cash flow that they can use for different things. And it can be deployed or allocated to paying dividends, paying some out to shareholders, which shareholders always like, right? Or paying down debt. You know, if you have debt on your balance sheet, you might want to pay that down and free up your balance sheet more so you don't have those obligations. Or it could be used for opportunistically. If there's growth opportunities that the company sees, whether to acquire another company or to invest in some business that could be very lucrative in the future, if it has the free cash flow, it has the latitude, that management has the latitude to make those kind of decisions and be opportunistic and take advantage of opportunities that make themselves available as you go forward. So free cash flow is a really key number to know. And so what is free cash flow? Well, it's basically the amount of operating cash, right, that exceeds the working capital requirements and also expenditures on fixed assets. Now, we need to buy fixed assets to keep a company moving, right? It may be you have to replace some machinery, or you have to buy more trucks, or whatever it is, some kind of infrastructure type of things that you have to buy in order to maintain the company over time, repairs, things like that. Those are all capital expenditures that has to happen. And where do capital expenditures show up? Well, they show up on the balance sheet as fixed assets, right? So how do we calculate free cash flow? Well, it's basically free cash flow equals EBIT times 1 minus the tax rate. We'll talk about that. Plus depreciation, we're going to add that back, minus capital expenditures, right? And then plus or minus net working capital, if there's a change in net working capital. Now I'm going to go through all these numbers with you, but that's basically the formula. Basically, all it's saying is the amount of operating cash after taxes, right? Without the working capital needs, that's this, and capital expenditures, that's this, right? The reason we're adding back depreciation is because depreciation on fixed assets, right, is a non-cash expense. We're taking that asset and saying, well, we're going to depreciate over a number of years over its useful lifetime, right? So we're actually making it more accurate instead of saying we spent $100,000 in this year for something and then after that you get the benefits but you don't show it. It's no, we'll do it in 5 years, say, and that'll be 1/5 of 100,000, which would be 20,000 a year. 20,000 expense this year, 20,000 this year, 20,000 this year. But on the income statement, that expense then, that depreciation expense, while it makes it more accurate for the net income, it's not cash. And we're looking for cash, what the free cash number is. So we have to add back those non-cash expenses and also take away non-cash revenues. Well, what are those? Well, that's accounts receivable, right? So there's two ways to look at this net working capital number. We'll talk about that. So first, it's the EBIT, and EBIT is right from it's the income statement, right? And the income statement is what? Revenue minus expenses equals net income. Well, net income is EBIT, and EBIT stands for earnings. And remember, net income, earnings, profit, those are all synonyms. They're the same word. You hear them bounced around a lot. They're the same thing. So remember that, right? So it's earnings before interest and taxes. That's what EBIT stands for. And so they also have EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So those are all, because those are all non-cash expenses, depreciation, amortization. We can add that in here too. So it's EBIT and then times 1 minus the tax rate. So it's really, EBIT is before interest and taxes, but now we're taking away for taxes. So we could even just do earnings before interest payments, right? Why we want to do that is because, remember, interest is incentivized in many countries, and so you get a tax deduction. Your interest payments are, you can take them as an expense against your taxable income. So that's why I want to have that in there. So then we're going to add back depreciation and capital expenditures and net working capital. And net working capital is the difference between your current assets and your current liabilities, right? Net working capital is the difference between current assets and current liabilities. And what are current assets? Well, current assets are cash in the bank, right? Accounts receivable and inventory. Sometimes you take inventory out because inventory really, as a current asset, is a little questionable, right? Because can you really turn all your inventory into cash very quickly? You certainly can with cash and accounts receivable, but inventory might be more difficult. So sometimes they take that out. This is where interpretation comes in. And so as long as you make clear how you're making your decisions about these numbers and what you're including and what you're not including and what assumptions you're making, if you have those all listed out, then when you talk to other people like your peers, your colleagues, or bosses, or who you're presenting to, you have all of your numbers and you have what your assumptions are, what you did with each number. Then they can point and say, well, you really should add this, or really that doesn't matter, and all those kind of things. Everybody can understand how you've come to your numbers, and that's really critical. That's why we use spreadsheets. That's why we save those files so we can go back and look when somebody else comes later and says, how the heck did you come up with this number? 8 months later, right? They come and ask you that. It's like, well, I don't really know. Well, if you can pull up the spreadsheet, you can say, here's all the numbers. When we are presented to them, you agreed to them, you bought it, all that kind of stuff. So it's really good to understand what these numbers are and understand that there's no hard and fast rules. There's some art to this. You're going to be making decisions what to include and what not to include. So there's the EBIT times that, right? Depreciation. Now, where does these numbers come from, right? These numbers are all from the cash flow statement, right? So we have some stuff that's related to the balance sheet, some stuff that's related to the income statement. The third, right, financial statement is the cash flow statement. And what is the cash flow statement? Well, the cash flow statement there's three parts to it. And remember that the top line of the cash flow statement is the bottom line of the income statement, right? We can actually put this right below here because net income is where we start. And then we're going to there's three parts to the cash flow statement, right? The operations, investment, and financing. And so the operations section is where all these numbers come from. And what they are they're the non-cash expenses and revenues, right? So accounts receivable is a revenue, and you count it as a revenue up here, but did you get that cash yet? No, you're still waiting for it. It's an account receivable. So if you haven't gotten that cash yet, what do we have to do? You have to subtract from net income that accounts receivable number because it's inflated from a cash standpoint in this revenue number, right? So that's why we take the cash flow statement is really making adjustments to the income statement to understand how much cash you have, and that's what we're interested in here. So depreciation and amortization that are also non-cash expenses, right? So we want to add those back, right? Add that back, and then accounts payable, same thing as accounts receivable on the other side, right? Accounts payable is our bills you have to pay. You've put them into your financial system and they come up as accounts payable, but you haven't actually cut those checks yet. You haven't actually paid those bills, so the cash is still sitting in your bank account. But you have to, it's an obligation you need to pay, but you haven't paid it yet. So you've already subtracted that from net income as an expense, right? But you haven't actually paid it from a cash standpoint, so we have to add back accounts payable. And so that's what these numbers are, right? That's depreciation, and that's the net change in net working capital. You could do the net working capital change also from right here. That's why I have that arrow here. There's two ways to do it. You could do it as your current assets minus your current liabilities. That's an easy way to do it if you say that's what you're going to do. And then you can also do it by doing the add backs and subtractions from the cash flow statement. So you can do it either way, and a good way to do it is to do it both ways and check and make sure your numbers are relatively similar. If they're not, find out why, right? So that's a good double check. So then capital expense. What is capital expense? Well, that's this part, expenditures on fixed assets. Those are the things you have to buy within the time period, and you're going to make estimates for that in the future, right? Because this free cash flow, you're going to be able to do it this way for historically and for this period you're in now. But to do discounted cash flow valuations, DCF, in the future, you want to look at what are the future cash flows and pull them back to present value, and that's how you're going to value that stream of cash flows, right? Free cash flows. And that what you're going to need to make estimates of how fast you think those things are going to grow, or maybe you think capital expenditures are going to go up or down, and all these kind of things, or your revenues, your net income are going to go up, hopefully. And so as those increase, then you pull it back with a discount rate, and that's your discounted cash flow formula. This is the number that we use for those cash flows. But you're going to have to make estimates in the future, right? So the CapEx is the capital expenditures, right? And you always hear that phrase CapEx and OpEx, right? OpEx is operating expenditures. That's this stuff here, right? And CapEx is capital expenditures. So you make those kind of decisions too sometimes. That's an important thing these days when automation is getting so prevalent. Is it good to have an OpEx or a CapEx? A CapEx might be, say if you have 10 workers on an assembly line and you could replace them with 5 robots or 10 robots, and the robots are going to cost you this amount of money, but you only pay for it one time, and then you depreciate it over time. And then the salaries for those workers are that's OpEx, operating expenses, are going to go forward. And you can compare whether the capital expenditure on the robotics is going to save you money over time relative to the OpEx, the operating expense of having labor. And remember, employees, that is on most companies about 60 to 70, 80% of expenditures. So it's a big chunk. You look at companies like Tesla or something where they're automating their entire assembly line, trying to build cars with not too many people. And there's lots of other automation other than physical robots too, right? And you can start to look at, do I really need to hire somebody to do social media for me? Or can I put in a couple of tools that will put out messages sort of like a jukebox or something? And you can see those kind of things as well. So that's what the capital expenditures are. And where does that show up? Well, the operating section of the cash flow statement would take care of depreciation and the net working capital needs, right? Then the CapEx comes out of the investment section, right? We have the operating section, the investment section, and financing section. Financing section is where if you did pay off some debt, that would go into here. Or if you receive some money, say from a stock sale where you sold stock in the company, that's not a revenue, right? It comes into the company as cash into the cash flow statement. So those are key things to know, right? We don't do anything with the financial section for analyzing for free cash flow. But we do look at the investment section to get an idea about capital expenditures. And if you looked at this historically, say if you look back 5 years and see, well, what are the investments? And then you could average that out, and that would give you a good idea of CapEx going forward, right? You'd understand, oh, this is approximately how much on average this company pays each year into investment in equipment, fixed assets and things, equipment. And then you get an idea, well, maybe that's going to be similar going forward. You can look at trends historically. That's why when you're using these things, a lot of times we use them with public companies because you can actually look at the financial statements, or with private companies where they give you their audited financial statements, and then you can start to make these decisions too. This is the way that private equity companies look at public companies and say, you know what? That company in the stock market is valued at, $100 million. And when we do our free cash flow analysis, we think it's really worth $200 million. So let's buy that stock, take the company private, do the things that we think we can do to increase that free cash flow, increase the value from 100 million to 200 million, and then sell it, and then pocket that $100 million as a profit to our private equity firm. That's how private equity works. So these kind of assessments are done all the time. This is the way analysts do it for the stock market, right? They'll look and say, gee, the stock is trading at a discount relative to our discounted cash flow analysis, or it's trading at a premium. If it's trading at a premium, you might say hold or time to get rid of that stock. Or if it's trading at a discount, it's a buy, right? So this is a key number to doing discounted cash flow analysis, right? So that's where the CapEx would come from. And so that's what this formula is here. And, again, free cash flow is a really critical thing to know. So I hope, I went through this in pretty much detail, and I will, put a copy of this slide, this whiteboard, I'll make a photo of an image and put it below this lecture too, so you can look at that. So now you know free cash flow, and you also know, weighted cost of capital, discounted cash flow. We've gone through all these different things. I'm going to make a next lecture that's going to be pulling all those together so that you can actually do an analysis of a company with all these different tools that you've learned. So see you then.